Now let's have a look at how we can deal with exchange rate movements through the process of hedging and the use of financial instruments called derivatives. So a quick recap. What are exchange rates and how do they impact businesses? We know that exchange rates are simply the value of one currency in terms of another. They are constantly changing, driven by changes in demand and supply of currencies in the foreign exchange market. Now, the problem they create for businesses is that of uncertainty, because it's going to change the Australian dollar value of transactions. Appreciations are an increase in value of the Australian dollar. It's positive for importers and businesses who have borrowed from overseas because as the dollar is worth more in terms of foreign currencies, they need less Australian dollars in order to be able to pay their bills or their loan repayments. However, an appreciation is negative for businesses who are exporters because their customers have to pay them in Australian dollars, which therefore they need more foreign currency to be able to do that, making our goods relatively more expensive and reducing our international competitiveness. A depreciation, on the other hand, is a decrease in value of the Australian dollar. This time it's going to be negative for importers and businesses who have borrowed from overseas because it's going to require more Australian dollars to pay their suppliers or make loan and interest repayments to their overseas creditors. But it's positive for exporters because now Australian goods become relatively cheaper overseas and our international competitiveness increases. So this video is all about dealing with exchange rate changes. The key here is to deal with the uncertainty associated with these movements. We want to be able to overcome this difficulty of planning the actual realised value of global transactions. We might find that our revenues are higher or lower than expected, or our expenses are higher or lower than expected because of unforeseen or unplanned exchange rate movements. Financial management strategies play a significant role in minimising exchange rate risk, or the risk that the business is going to be impacted by a movement in the exchange rate. The whole focus here is to give certainty, and we do this through a process called hedging. It's really important to remember, though, that whilst hedging is going to reduce the impacts of currency movements on the business, it doesn't eliminate the risk that those movements are going to occur in the first place. So what is hedging? Hedging are a set of processes or activities used by the business to limit the risk of loss due to currency fluctuations. So it's all about limiting transaction or exposure risk. There are two ways we can do this. The first one is natural hedging. Now, natural hedging just means the business is going to establish foreign subsidiaries over in those countries where they are buying their supplies from or they're selling to their customers. This then means that their customers or their suppliers will be dealing with those foreign subsidiaries and there will be no need to convert the currency. However, the syllabus is much more concerned with us looking at financial instruments or products called derivatives, and that's going to be the focus for the rest of this video. So what are derivatives? Derivatives are financial instruments that derive or get their value from other assets. They were developed primarily through financial institutions such as banks to reduce the uncertainty associated with exchange rate changes. The three the syllabus wants us to know about are forward exchange contracts, options contracts, and currency swaps. All three of these are named in the syllabus, so you could get a question on any of them, whether it be a short answer or multiple choice. So let's first have a look at forward exchange contracts. A forward exchange contract is an agreement to buy or sell currency at a fixed exchange rate at a future date. These contracts are issued by banks who assess the risk of how the exchange rate is likely to move, and then they determine a rate that they are willing to offer as part of the contract and a fee that they're going to charge for this service. Remember, the banks are there to make money, so it's very important that they assess the risk and get the right fee. No matter how the exchange rate changes, The business will therefore have a guaranteed exchange rate and they will have certainty over the transaction. The only problem with a forward exchange contract is if the currency were to move in favour of the business. They're locked into the contract and they're therefore unable to take advantage of that change. However, the certainty that this contract provides usually outweighs this risk. Options contracts. Options contracts are a right but not an obligation to buy or sell foreign currency at a future date. Again, they're going to be issued by banks who are going to assess the risk of how the currency is likely to change. Then they will determine the rate that they are willing to offer in that contract and the fee that they want to charge to provide this contract. This time the fee is likely to be higher, and it's likely to be higher because the business does not have to use this option, and so the bank still needs to make money off the contract. The good thing, however, about an options contract is it gives a degree of both certainty and flexibility for the business. They can utilise the option if the exchange rate moves in a manner that disadvantages them. But this time, they have the option of not going ahead with the contract if the exchange rate moves in their favour, and all they have to deal with or pay as a result is the fee for that contract, but then they can conduct the transaction at the spot rate at that date. Currency swaps. Basically, these are just an agreement to exchange currency now at a spot rate, plus an agreement to reverse that at some future point in time. They are actually reasonably common, but not the one you should really be focusing on in terms of your exam responses. So, in summary, global financial transactions have a higher risk due to a degree of uncertainty caused by exchange rate movements. These currency or exchange rate movements make it difficult to predict the actual realised value of transactions in Australian dollars. Remember, the impact of these changes on a business will depend on the nature of global transactions. So appreciations and depreciations will impact exporters and importers differently. Hedging can be used to limit the risk and give more certainty to the exchange rate associated with global transactions. Hedging is going to be done naturally through the establishment of foreign subsidiaries, or more importantly, from a syllabus point of view, using financial instruments or products called derivatives. The most important derivatives that we need to be aware of are foreign exchange contracts, options contracts, and currency swaps.